Welcome to another episode of the Wealth Guide podcast. In today's episode, we have a special guest, Peter White, Managing Director of the Finance Brokers Association of Australia, or FBAA. Peter has been a vocal advocate for the mortgage broking community, especially when it comes to regulatory matters. In this conversation, Peter will provide us with valuable insights into his goals for regulatory engagement and advocacy, the current challenges brokers face due to big bank stances on broker remuneration, and the steps the FBAA is taking to support the industry. We'll also explore Peter's future aspirations for the FBAA and hear the advice for emerging finance professionals as they navigate their careers in an evolving industry. So without any further ado, let's get started. So look, Peter, thank you for joining me. Really appreciate it. I wanted to kick off with the first question. Now, you've been a vocal advocate of the mortgage broking community, especially in regulatory matters. What are some of the key outcomes that you're driving in particular?
Yeah, thanks. And my pleasure to be here. It's always a good conversation that we have. So regulatory matters, it's really interesting point in time in that there are not a lot of primary things on the agenda at the moment, which, touch wood, is a good space to be in. It's an unusual space to be in. But most of the work that's happening at the moment is focused around tidying things up. Mm-hmm. There's a lot of that going on at the moment. Past acts and bills and so on that have been passed that needed to either be reviewed or just got reviewed, then needed a little bit more work on it. The Payment Times Act is a classic example of that at the moment. But the big focus, I guess, if there is one to say, is from a regulatory framing or regulatory front, is really the work that's going on around, whether we want to call this regulatory or not, but clawbacks and how payments work, net of offset. And we've had years of engagement with politicians and regulators around this. We've had Stephen Jones, the federal minister, come and have lunch with us on the 8th of July. That then framed a final piece, and that's now with him. And that's been our big focus in regards to, I guess, supporting the industry and also the needs of something that is a huge pain point for brokers in this country, and rightly so. I also chair an international federation for mortgage broking, and when I was in the infancy stages of that, I was doing a research piece. And I did that around the world of all the primary countries that use third-party distribution. It was around 2015, 2016. And the same rules still apply, or the same outcomes still apply today, is that Australia suffers clawbacks unlike anywhere else in the world. Right? So we got it the hardest globally. And you sit there and go, geez, well, if that's the case, why? What are we doing wrong? Or what is it that people aren't listening to, as in politicians and regulators, that actually makes that be the case? So it's quite strange. So that has been a really slow burn, right? Trying to get somewhere from that conversation from way back then. But we're now at last at that point where that piece will come to an end. We don't know at this stage where that will frame out, whether it winds up back in the hands of the Productivity Commissioner who laid down the rules in regards to how clawbacks could or couldn't play out, or whether it's something that has greater intervention from the Minister, or alternatively, and a part of the goal for this was not to have to go down that path, that lenders would just do the right thing and be fair and reasonable. No one's asking for something that's unreasonable, but the lenders just didn't want to get it. So kind of hope that they knowing that we're at the thin end of the wedge. And there's been a recent article in the Australian newspaper talking about clawbacks and what the majors have done. And yes, they have moved the benchmark around a little bit, but it's still way from being good enough. I mean, one of our big friends turned around and said, we're going to reduce the clawback thing. But what they did is they extended the risk for another 6 months. It's not such a good outcome, right? We're trying to manage it. Yeah, so that is a significant piece. It takes in a whole lot of other things. So the clawback conversation pulls in net of offset payments and so on.
I wanted to ask, what do you think is the root cause as to why clawbacks occur and they're so high in Australia, in particular, in comparison to other countries?
I don't have the answer to that, to be honest with you. It is the quandary of all of it is to say, well, why have we got it so hard compared to anywhere else? And the only answer that sits in the back of my mind is with the advent of broking back in the early 90s, I say that, and the growth spurt that it had through the mid-90s, so the 1995 era when banks were shutting down branches and brokers really started everything took off.
Right.
The big thing that happened also around that time with that competitive pressure, margins got squeezed. And I think they got squeezed to a point where they said, well, some things worked, something didn't work. But then we had a change of government at one stage that turned around and banned passing off what we used to call early termination fees back to the consumer. That then pushed those sort of clawback issues up, because all of a sudden the spread was only on one focus, not across two focuses, because clawbacks were already in existence at that time, but it was at a much lower level. And there's a big argument that sits around the back. So wait a second, this is cost of distribution. You don't take it back from your bank employees. Why are you doing it here? You've got it already built into your margin spreads. So aren't you double dipping? It's all these sorts of conversations that play around that none of them like to really sit down and talk about. I think Australia, when you look around the world, has such a strong third-party distribution front. Part of the scorpion's tail on that is the clawback piece.
And you recently commented on bank attitude towards broker remuneration as well, and the impact on industry competition.
Doesn't sound like me.
What, if you can you elaborate on the challenges that the mortgage brokers face?
So we had banks moving to reduce competition. That came out in a Senate inquiry that was recently held. And, they're looking at dropping, or some have already dropped to 0.4% from about 0.5 or 0.65, wherever they were beforehand. And it appears quietly behind the scenes, several have followed. The issue there is brokers are not charities. They're under business like anybody else. And therefore they have costs and expenses. It's not just like, the media beefed up some reports not long ago, and it wasn't the journalist's fault. It was actually fed to them by a certain bank. That the brokers make hundreds of thousands of dollars and the remuneration is really, really high. And this sort of justified the conversation. And then there are other conversations months ago that same party was talking about, the brokers actually were making a loss. Now, that's one of the biggest BSs on the planet, right? I know another major turned around and I don't know if they still have the practice, but they used to have the practice of saying, well, when we equate the viability of the broker marketplace or our broker distribution base, we take 3 years' worth of expenses and push that in the first year's revenue. Nobody makes money out of that. Right? It's just stupid, right? But that's how they said, it's viable or not viable. Oh, that's just ridiculous. So you get these underlying pins to say, well, really, is it that bad? Or is it so simple? And this is where I go to, is that you just don't want to do business with brokers, then don't. Be transparent about it. Everyone will have their dummy spit. They'll be over it tomorrow and they just won't give you business. Right? Simple as that. But be truthful, be honest to yourself and to the marketplace, and not play stupid games with pushing this one or pushing that one over there to try and actually create an angle. You don't need to. Just walk away and just say, well, we're not going to do it anymore, but our subsidiary brand over there is. Okay, well, whether we like it or not becomes irrelevant. It's a commercial decision and everyone moves on.
Well, we have seen that sort of attitude from this one particular bank over a period of time. Have you seen that?
I'm saying it without saying it, but yes.
Have we seen a change of brokers engaging with that bank after that sort of attitude?
Yeah, the media is reporting at the moment that has dropped. And I think 35% is the number, or 36% is the number that's being touted around. The reality is, there's a delicate balance as to how this plays out. Brokers must act in the best interest of the client. And if that lender has the best product and the product that's not unsuitable for the client's need, and the client says, I want that, et cetera, so it ticks all the regulatory and governance boxes, then that's what you've got to offer. It's not driven by how much money you make. It's driven by what the consumer needs, right? Yeah. So that will play out all the time. But again, if you look at it, all the majors, a home loan's a home loan. There's not huge differences. So if I don't have that lender on my panel anymore or on my accreditation list anymore, then I can't deal with that because I'm no longer informed about their current products and policies and so on. So I can only offer from this cohort. That's options that people need to think about.
Yeah. You've still got about 40, 50 other lenders there on the panel regardless.
Exactly right, yeah. But you got to remember, panel versus accreditation. Yeah. So the panels are big, the accreditations are a lot less.
Right.
But you need to make an informed decision that, one, you're not a charity. You can't send yourself broke. If you're going to deliberately send yourself broke, you shouldn't be in business in the first place. So there's a reality of business life in the decision, in addition to be able to act in the best interests of the borrower at the same time.
And there's the reality as well. The mortgage broker is a service provider. So at the end of the day, the client comes to you with a goal, and it's the mortgage broker's role to say, okay, based on your goal, in your best interest, this is the appropriate product for you.
Yeah.
And that's the service that they
Or
provide.
products. So
Or
they
products,
generally give
yeah.
at least three to six.
Yeah. And the reasons why.
Yeah. And they assist the borrower in making their decisions, determinations based on an informed position rather than, I'd hate to be a home loan borrower who doesn't know this pathway. It's really tricky because you don't know what's really going to work for you or not going to work for you, because all these little tweaks and variations and fees here and no fees there. It's it leads into one of the other regulatory conversations is around backbook pricing. Right. So the investigations that were undertaken by the ACCC last year that went up with a report going to Treasury, I think it was February, looking at backbook and frontbook prices. It was also looking at digitisations of systems and processes. And that started with a conversation with me and the Federal Treasurer at a breakfast meeting in Melbourne. And I was spitting the dummy over what was happening with backbook prices, and it wasn't transparent. And back in the day, we used to do honeymoon rates. Everybody knew a honeymoon rate, and it was disclosed in general was 1% below the variable rate. Once you get out 12 months, it goes up to whatever the variable rate of the day is, right? But you knew what it was. This whole backbook pricing where I say, hey, come here and play with me, and I'm going to give you a really good rate. I'm going to throw some money at you too. You're going to love that. To find out 6 to 12 months later, your interest rate's gone up 80 basis points. And you go, wait a sec. Yeah, that has to be transparent. Now, if it is the case, so long as it's disclosed in a transparent manner to enable the borrower to make an informed decision, it is what it is. I don't like it, and it needs to go, but it is what it is. But it's not transparent. It's not disclosed anywhere. That's a real problem. So that's a very interesting piece from a regulatory and governance point of view that we are working very closely with and have done from its non-conversation to creating its conversation to the various iterations gone through government departments.
And I think the conversation has eased somewhat in recent history with a lot of the lenders have removed their cashback offering for refinance as well.
Yeah.
Has that played a part in the service that a mortgage broker provides and the conversation between a mortgage broker and a client?
Yeah, it does, but it's almost gone. There's only a couple that provide those cash incentives now. And in all honesty, I think they're wrong. I've always thought they're wrong. I actually had a whisper in a certain senior minister's ear saying, why aren't we charging tax on this? It's money, it's income. Because there was a period of time through COVID where people had investment portfolios of 10, 20 properties, rolling them to pick up the cash back and getting $5,000 on each one and making a fortion out of it.
I heard a scenario somebody made up to $100,000 refinancing 7 properties. Yeah,
I know. So you sort of go, well, that's not the intent of it. And if you're going to play that game, maybe you should be taxed on it. But yeah, look, we didn't get there, but it's one of those things that now is almost gone. Like I said, there's only a couple of people that do it, a couple of players. And this is where the analysis gets tricky. You say, well, what is the value of that cash back compared to what interest rates being levied? Nothing's free.
No.
So where are you going to pay for it? And trying to analyse where that works out.
Because it's similar to the front book, back book offering, like you offering an incentive to get into a product and then it doesn't turn out to be the best fit for you ultimately.
But imagine the clawback that the poor brokers got after
and that's what
every
happens.
Year. And that was a terrible
escalated
practice.
the clawback piece, right? And so clawbacks are going up because, and again, it's slowed to a degree because those cash offers are no longer as prevalent as what they once were. Because it wasn't like a competition. It was a race to the bottom. Who can I give the most money to? And hopefully I don't go bust over it. You know? But they were the problems. And it just didn't make sense. Never made sense then, doesn't make sense now. And thank God they're almost gone.
Today's episode of the Wealth Guide podcast is proudly sponsored by Ryker Capital. In a world full of financial uncertainties, Ryker Capital understand the importance of safeguarding your lifestyle and the well-being of your loved ones. That's why we're committed to providing you with personally tailored insurance plans and financial advice that aligns with your unique needs and goals. Ryker Capital is your guide in the complex world of superannuation and retirement planning. Our team of experts are dedicated to helping you navigate these complexities with ease and confidence. We're here to empower you with the knowledge and strategies you need to build wealth and secure your future. At Ryker Capital, we offer a comprehensive range of services designed to optimize your superannuation. We work closely with you to determine the best contribution strategy, regularly review your superannuation fund, set achievable financial goals. Our coaching and consulting services ensure your financial plan stays on track with regular reviews to adjust to your changing circumstances and aspirations. Don't leave your financial future to chance. Take control today with Ryker Capital. Contact us for an obligation-free discussion about your financial plan by calling us on 1300 179 537. Let us help you secure your finances because you deserve it. Ryker Capital, your trusted partner in financial success. I was hoping you could describe for me what FBAA is doing to support brokers with these regulatory issues. We talked about front book loading and regulatory clawback.
So we've taken a very strong frontline advocacy position with government since 2008. And I tagged that date because that's when I first started doing that for the association, but that was the first time we put, I won't say single focus, but a primary focus on the advocacy that happens through to government and with regulators. And so we have various forums that we use to interact to gauge broker sentiment, or member sentiment, I guess is the best way to put it. Together with, from time to time, we'll use certain research structures to be able to gather data, to be able to build the customer-facing broker data into our submissions, our content. Now, we're very fortunate. We have a guy who is it's a trade secret though, you can't tell anyone. He's my ghostwriter. He writes all our papers. Yeah. He's ex-ASIC. He wrote RG 209 in its first iteration. He was in enforcement there, and he's a lawyer. So he thinks and writes like a regulator, but he's a really good bloke. So that's our little secret weapon. Yeah. And we've had enormous tractions and outcomes over many years now with actually regulators and or governments changing their decisions or reframing their thoughts on things coming off the papers that we've done. And the most recent one was on the reference checking protocols, whereby the regulator came back and said, we finished reading your paper. You don't always get an acknowledgement to actually read anything, right? So that was a good point. And they said, and we're going to change that part of our scripting so it reads along the lines that you've said. Are you happy with that? I almost fell off my chair. And so we've done it here and here, and are you happy with those areas as well? And so then they got the pacemaker and gave it a real kick, because that never happens. Yeah. But that's the impact, I guess, of years and years and years of doing, putting the right sort of framings over a long period of time. So we don't push for anything that is not in the borrower's interest or is driven by commercial greed or anything like that. There's none of that influence in anything that we do. So it's all about the long-term nature of our industry and association to say, well, this needs to get fixed because of this problem. Or if the regulator thinks it's a problem and it's not a problem, and therefore we've got to reach out into other worlds quite often. And I chair this international federation, and we use that to gather data, because when regulators and politicians look at framing new legislations or regulation into this country, they first look overseas and say, well, what did they do over there? And then they take that data and put it into their thought processes. That's why I set up the federation back in that 2015-16 era when we started beginning to put it together. Because if I want to be ahead of the curve of that conversation, I've got to know what's going on in other countries. Yeah. So it was very self-serving, but that's okay, because now everybody has the same benefit that's a part of the federation. But it's that greater knowledge, that global knowledge, that together with a smart writer behind the scenes, I've been in the industry now 45 years. Hopefully I've understood one or two things at least along the way. When you bring all that together, it actually creates a really powerful mix and gets the outcomes.
Pete, just to the point there before, I'm like, for me, the regulators change all the time. Governments changes all the time. Some of these things that we want to sort of pass with the government takes a while. How do you keep up with?
It's a pain in the ass. You can cut that out if you want.
No, it's fine.
But it is a real problem. So there was a period in time around, it probably was between 2014 or 2017, it was in that sort of bracket, that every 6 months they changed the financial services minister over 2 years. So that's 4 financial services ministers in 2 years. And what happens is there's no carriage of knowledge. So you reset to zero every 6 months. And they do that so that there's no undue influence on knowledge sets and so on. There's a reason for doing it, but from an industry point of view, it's absolutely horrendous, to the point when I got to the fifth one, we're sitting down, it was a meet and greet dinner function. I was sitting down, I was sitting next to him. I said, so you're new to the role? I'm going to take the assumed position, you know nothing. He went, yep. I said, well, and I had this pile of papers, and he's walking around all night with it tucked under his arm, right? I knew that was going to happen. So we started off that new minister, that fifth one, with a little bit more informed knowledge, assuming he read it all, which he's the kind of person that did. So, yeah, right. It's really problematic. You know, one of the interesting things is, though, politicians changed a lot. The actual public servants in the system move around the system, but they're still there. So a recent example of that is we have a new shadow financial services minister in the coalition. So we had a catch up and meet. And when I was organising it, the guy rang me and said, look, we need to get together, have a chat, blah, blah, blah. So yeah. And, you know, you get so many names go through your mind all the time. And he said, you know who I am? No. Light instructor, you know what? He was the chief of staff of a previous minister when they were in government. And when we last spoke to him, and it was all around broker remuneration, it was a time when the government said we're no longer going to investigate broker rem, right? And I won't comment on what else happened, but principally the messaging that came out was because the data said there's nothing to see here. And what happened was that somebody got the jump on me, got a media scoop on it. I was playing catch up because I was speaking on stage at a conference. I rang him on Monday and started to tear strips off him, saying, well, why wasn't I told her? And I got the same because I said, Pete, you know who this is? I don't use names. We worked together when you were doing a paper with ASIC, and we formulated some new policies. It was like 5 years ago. So now all of a sudden I've got a 15 plus journey with this one person that keeps popping up. And those relationships are huge. Yeah, they really are.
I feel it's the same in superannuation circles. But every government changes the superannuation legislation and tax almost to appease voters sometimes, I find as well. And it's just a matter of, you know, getting your head around
some really good key people that sit underpinning these federal ministers. Yeah, once you get to know them and they get to know you, and this is, I guess, the value benefit of what FBAA does for its members. I've been doing this since 2008. I'm a licensed, registered lobbyist with the federal government. They see me everywhere all the time, and so all of a sudden you're not an unknown, and over such a long period of time the trust has been built. So it's not like they're trying to go, is this person trying to do, you know, slip one under me? You get none of that going on.
They know you're legitimate.
Well, but you've built that relationship and that trust over a long period of time. And that is a huge value in our conversations, politically and regulatory, on behalf of our members, because otherwise, and we see some things that happen, you say, no, you shouldn't have done that. No, don't do that. That doesn't work, and et cetera, et cetera.
Ultimately, at the end of the day, if we fast forwarded into the future, whatever timeline, what is the outcome that we're looking to drive towards for the FBAA?
I guess it's all focuses around the sustainability and future of an industry. So it doesn't matter what the conversation is. That's one of the key goals in that conversation, is to ensure that you don't have someone, or you don't step in the puddle of that you don't want to step in, and you make a rod for your own back. Now, there are various things that happen in our industry at the moment that are making a rod for our back, and they're playing out. We have a habit of talking too much about ourselves, what our volumes are, what market penetration is, how much was written this month and that month. And it's all good information for us to understand. But it gets in the hands of regulators, politicians, and these days the banks, who are now stabbing us in the back with that detail. And we still do it. And say, guys, you need to stop. This is great, but you're actually creating a problem for the future. And the problem for the future is going to be a reduction in commissions. Correct. It's probably going to be a reduction in the number of people in the industry. A reduction in the number of lenders if you're not careful. There's a whole host of things that will happen at some time in the future. These are the first runs on the ladder. Well, let's not get halfway up the ladder, because it's really going to hurt. But everything I do is premised on that future-facing consideration, as to make sure we have a successful and sustainable industry.
Peter, thank you very much for your time. Look, we come to the end of part 1 of this awesome episode. What we're going to do is we're going to take a quick break, and then we'll be back and we'll talk shop a little bit more. Thank you very much for your time.
Thank you, Pete.
Thank you.
The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
If you enjoy the content we bring you on the Wealth Guide podcast, we'd love for you to subscribe and share with your community. Let's grow this community together and make financial literacy accessible to all.